What if I told you that everything we've been taught about saving money is actually completely backward compared to how the ultra-rich do it? I mean, think about it. For decades, the conventional wisdom here was pretty simple, right? Put your savings into fixed deposits, buy some gold, pick a few blue chip stocks, and maybe buy a rental flat if you can afford it. That was the dream. But a major new report has just blown the lid off the secret financial strategies of the country's wealthiest dynasties, and honestly, the findings are absolutely fascinating. Here's the crazy insider secret we're unpacking today. India's ultra-rich are abandoning those traditional, safe assets at a pace we've literally never seen before. They're taking up to 45% of their massive fortunes and deploying it completely outside of regular bank deposits and the public stock market. And this isn't some slow generational shift. It's happening right now at blistering speed. Instead of playing it safe, they are pouring billions into a totally different asset class. So it really makes you wonder, are you investing completely backward compared to billionaires? Okay, let's dive into this. To make sense of this massive shift in global capital, here's our roadmap for today's explainer. First, we'll uncover the billionaire wealth secret. Then, we'll step inside the family office. Third, we'll crack open the alternative asset playbook. Fourth, we're going to look at the rise of next-gen leaders. And finally, we'll break down exactly why this matters to you. Part 1, the billionaire wealth secret. To really wrap our heads around this secret, we have to look at a landmark joint report by Swiss private banking giant Julius Baer and the global consulting firm EY. It's called the Indian Family Office Playbook, and it completely lifts the veil on how the elite actually invest. But first, we need to talk about the sheer scale of the money here. The report reveals that assets managed by these private entities are compounding at a rapid 14% annual growth rate, and they're projected to expand 1.5 times over the next 36 months. In just 3 years, this private wealth pool is expected to cross 1 lakh crore rupees. Just to put that into perspective for a second, that is enough capital to fund the construction of entire megacities or completely transform a nation's infrastructure grid. We're talking about a level of financial firepower that literally moves entire markets. But the truly shocking finding inside this report isn't just the size of the wealth, it's where it's going. Nearly half of all this money, a massive 40 to 45% chunk, is completely bypassing regular stock markets. Instead, it's being poured directly into what are called alternative assets. This isn't just a slight tweak to an investment portfolio, it is a fundamental reimagining of how the richest people on Earth grow their money. Part 2, inside the family office. To really understand how this shift works, we need to define some terms and look at the actual day-to-day mechanics of billionaire wealth management. Because, what on earth even is a family office? Well, when a normal person earns a salary, managing finances is pretty straightforward. You've got your savings accounts, some mutual funds, maybe health insurance. But imagine for a second that you build a massive industrial empire, or you sell your tech startup for 5,000 crore rupees. Suddenly your wealth is so gigantic that managing it is basically a full-time corporate enterprise. You've got cross-border taxes, private jets, incredibly complex inheritance trusts to prevent future legal disputes, and of course, the constant battle against inflation. To handle all of this, billionaires create a family office. It's basically a private corporate firm that acts like a personal mini-bank. They hire professional chief investment officers, tax attorneys, the whole shebang, and their sole full-time job is just to manage the wealth of that single family across multiple generations. Now, why do these family offices feel the need to move away from traditional assets? I love this analogy. Imagine you're building a fleet of ships to cross a really dangerous, stormy ocean. Traditional assets, things like bank fixed deposits and gold, those are your heavy wooden lifeboats. They're incredibly safe, sure, but they are painfully slow. Public stock markets, on the other hand, are like large commercial ferries. They travel fast, but when a sudden geopolitical storm hits or algorithmic trading triggers a massive market panic, every single ferry in the harbor rocks violently at the exact same time. Alternative assets, though? Those are your high-speed exploration yachts. They require expert navigators, and they for sure carry higher risk, but they can discover completely new trade routes and entirely new islands of wealth long before the crowded public ferries even know those routes exist. Historically, wealthy Indian families were kind of just passive custodians of their money. They parked it in those safe wooden lifeboats and passed down family real estate.
But we are seeing a massive demographic explosion. India's ultra-high net worth population crossed 19,000 individuals in 2024, and it's projected to pass 25,000 by 2031. Because of this boom, family offices have completely transformed. They aren't just playing defense anymore, they are aggressive. Active capital allocators out there looking for those high-speed yachts. Part 3, the Alternative Asset Playbook. So let's break down exactly where this 45% alternative asset allocation is actually going. Let's keep it simple and skip the heavy financial jargon. According to the Julius Baer and EY researchers who looked inside these portfolios, the Billionaire Playbook is built on 3 main pillars. You have private equity and venture capital, private credit, and finally, yield products. Let's walk through each one step by step. Pillar 1 captures about 10 to 20% of their total money. Now, instead of waiting around for a high-flying tech company to launch an IPO on the stock exchange, when share prices are already sky high and the whole public is rushing in to buy, family offices are investing directly into promising private startups years before the public ever gets a chance. But here's the really brilliant part. They don't just hand over a check and cross their fingers. When a billionaire's family office takes a seat on a startup's advisory board, they're actively using their massive, established industry connections to introduce that startup to huge key clients. They basically help artificially guarantee the company's success. This dramatically lowers their risk and lets them capture exponential early-stage growth. Then we have Pillar 2, private credit. Right now, commercial banks are facing really strict regulatory lending caps, so growing mid-sized companies are often struggling to secure quick debt financing. Guess who steps in? Indian Family Offices. They act as private, unregulated lenders, providing customized business loans that offer steady, high-yielding annual returns of 12 to 16%. You might be wondering, why on earth would a company agree to pay 16% interest to a wealthy family instead of just going to a regular bank? Because traditional banks are slow. They are bogged down by strict regulations and months of endless paperwork. When a fast-growing company needs capital to buy a competitor or build a factory by next week, they need speed. They need flexibility. And the best part for the family office? This debt is heavily secured by real business collateral, making it a super safe bet for them. And that brings us perfectly to Pillar 3, institutional real assets and yield products. We're talking about things like real estate investment trusts, or REITs, and infrastructure investment trusts. This is where wealth generates highly predictable quarterly cash payouts, backed by massive tangible assets. Think about it this way. The next time you pay a toll on a major new highway, or spend money renting space at a premium commercial shopping mall, a portion of that cash might literally be flowing directly into a yield product held by one of these family offices. It gives them a steady, unstoppable stream of income built right into the very infrastructure of the country. Part 4, Rise of Next-Gen Leaders. So what's actually causing this dramatic, aggressive evolution in private wealth? Well, it all comes down to a really powerful demographic shift. The report points out an absolutely staggering statistic. Nearly 20% of high net worth individuals in India are now under 40 years old. That's huge. These next-generation family members have often studied at premier global universities. They've worked in the high-stakes environments of Silicon Valley or London, and they've built massive international networks. And they're coming home with a completely different appetite for risk. Unlike their parents who might have just wanted to defensively hoard cash and buy up conservative plots of agricultural land, this younger tech-savvy generation, they want to aggressively build and scale. When these young leaders step up to manage their family's capital, they absolutely refuse to just copy and paste their parents' traditional real estate or textile businesses. Instead, they are directing billions into futuristic, sunrise sectors. We're seeing massive investments into artificial intelligence, semiconductor manufacturing, climate tech, green hydrogen, cloud data centers, and advanced healthcare. And family offices are perfectly positioned to fund this stuff because sectors like green hydrogen or AI, they are incredibly expensive to build and they don't produce profits overnight. They require what we call patient capital, basically money that a wealthy family can just let sit for a decade without demanding a quarterly return to satisfy a frantic public stock market. Part 5. Why this matters to you. Okay, let's answer the ultimate question for everyone watching this explainer. How does the news of billionaires playing with high-speed exploration yachts actually affect your daily life, the local economy, or your personal wallet? Well, first, on a macro level, this capital creates a powerful domestic funding shield. For the past 10 years, Indian tech startups were heavily dependent on foreign venture capital.
when global interest rates spiked recently that foreign money dried up almost overnight. It triggered a massive funding winter, shutting down businesses and causing huge layoffs. Having domestic family offices step up as patient, long-term investors acts as a shock absorber. It literally stabilizes the everyday economy. It means the consumer tech apps you rely on every day don't just suddenly shut down, and thousands of high-tech engineering and manufacturing jobs are protected locally, which really anchors the country's economic sovereignty.
However, we absolutely have to address a crucial warning delivered straight from the report itself. Everyday retail investors, meaning you and me, should not blindly copy a 45% allocation to high-risk private equity. Billionaire families can totally afford to lock away 40% of their money for 10 years because their basic living expenses and safety nets are completely permanently secured. For a normal person, this kind of investment is highly illiquid. You can't just easily cash it out. If a beginner tries to copy this playbook and suddenly faces a medical emergency or a job loss, they'd be financially trapped without access to their own cash.
So what's the real takeaway for you? You need to adopt the core principle behind the billionaire strategy, not their exact percentages. The absolute biggest lesson is that you must diversify beyond simple cash deposits. Relying on traditional fixed deposits alone will slowly, silently eat away your purchasing power over time because of inflation. Think about it. If your savings account gives you a 4% return, but the cost of your groceries and your rent goes up by 6%, you are mathematically losing money every single day. Instead, you should explore regulated income-generating assets like public REITs and index-linked equities. That's how you build a resilient modern portfolio for yourself. When we zoom out and look at the grand narrative arc here, we're witnessing a truly fascinating evolution. Just like the legendary family offices of the Rockefellers in America or the Wallenbergs in Sweden, who literally funded industrial revolutions over the past century, Indian family offices are doing the exact same thing right now. They've evolved from being passive custodians in the past to active alternative allocators today. And they are setting themselves up to be the future anchors of national infrastructure for the next 50 years.
To wrap it all up, this shift is a high-stakes evolution in how capital creates lasting value in our modern economy. Now that you've peeked inside the playbook and seen how the ultra-rich are diversifying way beyond traditional bank deposits and gold, I want to leave you with a final, provocative thought. Take a close look at your own financial strategies. What percentage of your long-term portfolio is allocated to modern growth assets versus traditional safe savings? Let that question guide the next steps in your own wealth journey.